avoiding fakeouts and being flexible. Let's talk about it. Not a whole lot that you can do for fakeouts other than managing your risk, but you can use multiple time frames for confirmation, and I stress this a lot to newer traders. So what we're doing right now is reviewing the 2 trades that I took today on SPY. I took 2 trades, both for 10%. I had trigger levels set at 393 and 388. I was being flexible. I was adjusting to the price action that was offered. I know the trigger levels weren't broken, but we still were able to make something happen. And I traded this in the challenge account. So if you don't know, I'm taking $1,000, right? And I'm day trading options to see how far I can grow this account. Started with $1,000, I think about 40 days ago now. We are now at $5,356. Today is day number 42. I haven't posted the results of today yet just because the app was kind of bugging out. So I'm going to let that settle and I'll log in later and post those results. But here are the trades that I took. So being flexible, avoiding fakeouts. Let's start off with today's price action on SPY. Straight off of the day trade watch list, I suppose I should show you this first for verification purposes. Day trade watch list, we had SPY long over 393 and a short under 388. So we drew 2 trend lines at those levels. 393, short below 388. Neither one of those levels broke, so Gates, why would you take a trade? Moving this to the 1-minute time frame, this is what I saw. This pattern here is known as a symmetrical triangle pattern. It's a series of lower highs. So here's your high, lower high, and higher lows at the same time. So here's your low, higher low, all converging to a point. And the idea here is that when you get a breakout or breakdown from the symmetrical triangle, when you get the lower lows or when you get the higher highs, you're getting that confirmation of a breakout. Now, this is where it gets tricky. This is what this looks like on the 1-minute time frame. And the 1-minute time frame can have a lot of fakeouts. So you have to be careful. When you're trading something, especially as a newer trader, what I recommend is that you do is use 2 different time frames for day trading at least. You want to use the 1-minute time frame or the 2-minute or the 3-minute, something small to kind of pinpoint your entries, but always have up the 5-minute time frame for confirmation, because you see this chart looks much different than what we were shown on the 1-minute time frame. Looking at this, you might see, maybe something like a range, for example. Just below where SPY dropped from the symmetrical triangle, we actually have the previous day's closing line, which is noted by this green trend line here. That's fairly important as well. But I'm going to flip this back to the 1-minute time frame and show you what I was looking at in real time with the alerts that I was sending out. So in the alert room, here's what I said. Next idea, SPY symmetrical triangle shaping up. Load calls and puts, right? So symmetrical triangles, they are neutral patterns. They can break out, they can break down. We don't know, right? That's why they're called symmetrical. They can go either way. So in preparation to take this trade long or short, depending on where it broke out or broke down from, we load calls and puts, right? Just go ahead and get them ready. I give you the chart, what I see, right? I give you the pattern, okay? So it's verifying that the symmetrical triangle is there. And I tell you the exact contracts. Loaded these calls and I loaded these puts. I'm waiting at this time, no position yet. 9:48 a.m. I said, get ready, SPY short. What did I see? Well, we have the pullback creating the higher low here. And 9:48, we get this candle down. And I say, I'm typing, get ready, SPY short, right? We're getting ready to take this position because had this candle closed down here and then gave us another green candle testing this line as a resistance, which was prior support, testing this line as a resistance. So had we had a close down here, a run up to test it as resistance, we would have went short for the move back down, for the move lower. So I said, get ready, SPY short, here we go, right? But then 1 minute, what is this? Yeah, 1 minute later, wait, that was a fake out short. What happened? Well, we got the breakdown from the symmetrical triangle. We did. But this candle wound up getting bought back up. So the low of day validated as support. The previous day's close validated as support. Next candle started to print green and was a bullish engulfing candlestick. So this is a fake out short right here. It traps the bears. So how can we avoid it? Well, if you're watching the 1 minute time frame and you market buy into this weakness, there's not a whole lot that you can do to avoid that fake out. The only thing you can do here is just, if you're market buying this short on the breakdown, is stop out on the very next candle and hope that your risk is managed enough to where this doesn't become, a really large loss for you. So first thing you can do to avoid fake outs or to manage fake outs is just stop out immediately, right? If you're wrong on the trade, then so be it. This is trading. Fake outs happen. Just close it out right away, because if you don't close it out on this candle, look what happens, right? It rallies up all the way into the high of day. The other thing you can do to avoid these fake outs is to not give so much weight to these 1 minute time frames and to these 2 minute or 3 minute time frames. Give more weight to something like the 5 minute time frame. So yes, you want to use your 1 minute, 2 minute, 3 minute time frames to pinpoint your entries, because you can get a much faster and accurate entry that way. But you also want to make sure that you're using the 5 minute time frame for confirmation, because what this is telling you when this 5 minute candle closed is that we're not breaking down. In fact, you're getting this bottoming wick off of PDC here, and that's telling you the price action actually got bought back up, and so much so that it got back up close to the resistance. Next candle breaks the resistance, right? So we move back to the 1 minute time frame, and we're going to get back into the alerts. What did I say? Wait, SPY was a fake out short. Next, same minute, prep the long, and I said at 950 SPY, we're going to try this long on the next dip, but you got to be careful with your sizing, right? So here's 950. We get the rally up into the high of day, the pullback, and then the dip lower off of that pullback, and actually went long at the bottom of this candle, and then it was just kind of a waiting game from there. I said SPY long as a go on the next dip. I give you those, right, re-alerting you, same contracts, and then where I took my entry, 9:53 a.m., took entry, SPY long, 218 fill, stop loss will be 391. So 391 is right there. So why would it be 391? This is something that you may know already or you may not know, but I'm going to tell you anyways. The area where a pattern breaks out of or down from is a hidden level of support and or resistance. I'll say that again. The area where a pattern breaks out of or down from is a hidden level of support and or resistance. So if we were to extend these trend lines, where they kind of converge, where this point kind of converges at, is right here at 391. And look at this. For verification purposes, that's why that was my stop loss initially, right? But for verification purposes, after this run up, look at where it dipped and then bounced and started to run again. You see what I mean? Okay, so that's why 391 was noted as a stop. And then I, just managing the trade from here, hard stop placed at 190, down about 2%. And then I said OCO bracket set. If you don't know what the OCO is, I have a video on that. Just look at my page and search OCO. 2.40 price target, 2.0 stop. We hit high of day, 10 a.m., hit high of day, up 10%. You can take your profits or hold. I closed there. So entry price, 10 a.m. pop right here, sold into that strength at high of day. Why would I do that? Why would I sell at 10%? Well, we were already holding through this chop and consolidation, right? That's the first thing. Number two, SPY's contracts move pretty quickly. So the last thing that I want to do is be up and profitable and green on a position, especially this week with the Fed coming up. I don't want to be up and green and profitable on a position and then watch it come back down. We expected to see chop today and probably Tuesday and probably Wednesday leading up to that Fed meet. So I put it out early. Today's going to kind of just be the day where you want to take what's offered, take your profits when they're offered, make sure you're securing everything, and don't hope for anything too big until after the Fed meet. So pop move up into the high of day. We were correct on the trade. Take your profits at 10%. Looks good. Also, what did I say about 393? Well, again, straight off of the day trade watch list, SPY was a long above 393. Those levels that I pick on the watch list, they typically come from significant levels of support and resistance based off of a number of things. 393 was that level today. This is extremely close to 393. Where we sold, we're only 60 cents off from 393. And sure enough, when it rallied up, if we didn't sell at 10%, we might have been able to get 12 or 13% off the top. We weren't missing much profits there. before it rejected. Now, this is where I talk about being flexible. So the first part of this video was avoiding the fakeouts, things that you can do, right? Trading on multiple time frames, being flexible. Even though SPY did not break the trigger level set on the day trade watch list, which was long at 393, we can use that same level as a potential point of resistance to flip it short if that is the scenario. So understanding that, again, the Fed meets upcoming. We didn't think that we were going to really have a directional day. We kind of knew from this morning's symmetrical triangle that we were entering into a chop day. When SPY rejected at 393, right, had failure here up near the high of day, this is a great place, a good opportunity to take what I like to call a low risk trade. Meaning, I mean, it's still risky, but it's low risk because you have a defined stop loss. Go short on the rejection up here at 393 or near 393. It's close enough. Short on the rejection up here as it's rejecting the 393 high of day level for the move back down. All right, so we'll walk you through that trade. Let's go back to the alert room. I talked about AMD. AMD was a beast today. I missed that entry. Was really close to taking it, and I just didn't go for it. But that initial fake on SPY was wild too, right? That almost got me. We almost went short there. And then I said here, actually taking SPY short here. Watch list rule 4. All right, so go through the watch list training channel, posted right here. Make sure you're studying your rules. It's all posted for you there. 16 videos, multi-hour training program. Watch it. It's going to help you out. Watch list rule 4 on SPY. I give you the put contracts. 1.28 fill, stop losses high of day. Again, that's at 10:06. So it's right here. What I saw was, again, the chop that we experienced early on. So I didn't think today was going to be a directional day. Number 2, rejection at 393. Number 3, rejection at high of day on SPY. And as this candle started to form and come down, I wound up market buying about halfway through this candle. And again, just closed it down here for my 10% profits. So 10:06, that was the entry price and everything. 10:07, I said, please manage your risk. 10:08, a couple minutes later, 2 minutes later, closed for 10%. Entry 1.28, now at 1.42. And then I said, look, I'm sorry. I know that trade was fast, but I just saw it set up. Sometimes, this candle right here, that's all that you need to see to be able to take an entry for confirmation. And I wanted to get an entry as close to the high of day as possible, because if high of day is my stop loss, the closer that I enter to the high of day, the lower that my risk is going to be. So yeah, it was a lot to market buy this, type it all out as fast as I can, send it out in chat. But even though the alert came out, I think maybe the alert came out closer to the bottom side of this candle, had you just market bought there, you still were offered a ton of profit percentage on this drop down. And you would have been green the whole trade, because this never even reclaimed this support area. So if you entered anywhere on this candle short, even on this rally over here, you probably you still should have been green before the move even lower down to 391. So that's it. Avoiding fakeouts. Again, not a whole lot that you can do there other than manage your risk, cutting the trade right away, or using multiple time frames for confirmation, and then being flexible. I know that SPY did not break the trigger levels, but using pattern identification and price action, we were able to determine where a good place to take a long entry would be and capitalized on that, and then used the long trigger actually as a point of resistance, again, being flexible, to take that short for the move down. And you might say, Gates, those are insignificant trades. They're only 10% each. Yeah, but 10% plus 10% profits using the same amount of capital adds up to a 20% gain, and that is admirable. All right, that is it. That's my video for today. Press that like button for me if you enjoyed this content. Subscribe to the channel if you haven't done so already. I feel like this was pretty good. I feel like this was course quality content. If you agree, drop a comment and let me know how much you loved it, or if you hated it, no, don't even drop a comment. Just don't even say anything if you I'm just kidding. I know you loved it. All right, thank you for your time. Enjoy your afternoon, enjoy your day, whatever time you're watching this, and I will see you all in chat. Take care.